So the deal that you originally had taken as a customer, maybe a year ago, 2-3 years ago, and you're still on that fixed period, that part would still have the same expiry date, and you would move and put the security onto a new house. So that's what we call porting. So it comes from the old house and it's moved over and it's put onto the new house. And then if you did need more of a mortgage, a separate part, that separate borrowing or that separate part would be on a different contract, a different term, a different deal. So you'd have two deals that come off their fixed period, or if it was a tracker, or their period of the end of the deal at two different times. So it does get a little bit more complicated in checking your diary when the deal comes to an end, or when you're with that lender. And it kind of promotes that you're going to stay with that one lender for a long time then, which is not good for the customer in a way of thinking, I want to have the best competitive interest rate and I want to be able to move every time my deal comes to an end and really shop around. Now, if you do that and you do port, the likelihood is that you're going to stay with that lender, because every time that you try and move or go to a different lender, it will incur costs. And sometimes those costs can be more cost effective by moving to a cheaper lender, and it can make sense to move to a cheaper lender. But you've just got to understand, what's the exit fee? Is there an early repayment charge? Can that be, is it worthwhile financially to do that? And that's what the advisor would do for you and explain, there is an early repayment charge of this, we found out from the lender, and then what do you want to do at this point? Or I'll port my mortgage, please, and I'll port it over with an extra part. It's still good to always go back to the same lender and check what they're offering. But a customer wants the best deal.